Hello friends, this is Rahul Magan here as a Chief Executive Officer of Treasury Consulting LLP, and this time we are targeting a video which is fundamental review of trading book dual netting sets. As you understand that effective 2018 lot of action is happening in the market, like effective 2018 your Emir will get applicable, effective 2019, effective 2018 your MiFID will get applicable, effective effective 2019 your FRTB is getting your FRTB is getting applicable. So from a regulatory standpoint, there is a lot of action which is happening, and of course a lot of videos which would be covering that. Now here we are discussing fundamental review of trading book dual netting sets. Before that, let me give you a small introduction of that. So we have a company which is Cognizant Technologies Limited. Everybody know about this company. This is the best IT company which we have in India, and I think their top line is approximately $15 billion something. They have a huge amount of export receivables. Now let me write here these export receivable. If I'm not wrong, this is 15 billion. I think this is greater than that. So total export receivable for a year, it is roughly 15 billion, and it is spreading in all the currencies. For a minute, for the sake of simplicity, we assume that this is in dollar terms. And they are hedging using forward and options. In fact, Cognizant is a company who is hedging using long-term forwards. So they are the one who are taking more than 7-year forward contracts. And they have the signed CSA also with the banks. CSA stands for Credit Support Annex, which we are going to touch. And they are taking options also. So as a company, they are taking long-term forward positions till 7 years, and but they are not taking freestanding hedges. At the same time, they also take options also, and they are considering both fair value option and net and fair value and cash flow hedging. But they are not taking net investment hedging, if I'm not wrong. They are not taking net investment hedging as yet. So what would happen is that we have a company, Cognizant Technology, who is having export receivable of 15 billion. And this export receivable is hedged using forward contract or options. Assuming they are the banks, which is JP Morgan Chase, Standard Chartered, Citibank, Deutsche, HSBC, Barclays, DBS Singapore, UBS, Australia, New Zealand, Westpac, Commonwealth Bank of Australia, Bank of New Zealand, and Scotiabank. Of course, assuming these are the banks which they have. Now the point is, as you know, that Basel III is getting applicable. And I hope you have noticed that there is no Indian bank which is here. All are international banks, and majority of them are applied to Basel III. Since they apply to Basel III, they have a lot of valuation adjustment which they have to keep in their mind, and the pricing of the contract is subject to these valuation adjustment. Example, in the interest of space, let me write here. You have debit valuation adjustment, credit valuation adjustment, funding valuation adjustment, XVA, margin value valuation adjustment, capital valuation adjustment, and there are many. OIS, which is collateralization valuation adjustment. So these, and the list is very long. So there are many valuation adjustments which they have to dealt with, and these valuation adjustments are impacting the price of Cognizant once they are dealing with the banks, because for that they have to set aside a cost. And that cost they are charging from the price which they are giving to Cognizant. I repeat, once Cognizant deal with all such banks like JP Morgan Chase, Standard Chartered, Citibank, Deutsche, HSBC, Barclays, and others, majority of them, in fact all of them, are to Basel III. For that they need to set aside, they are going to have this valuation adjustment. And believe me, after FRTB, which is fundamental review of the trading book, these valuation adjustment is going to play a very important role. This is my personal belief. There's a lot of action in the valuation adjustment. Like there is an action which has happened in the Tokyo also about the CVA, which is credit valuation adjustment. And believe me that next week onwards we are starting a dedicated series to MiFID also. Your AMIR, it is European Market Infrastructure Access, regulation, EAD, CRD, Capital Reform Directive Sport, Basel III. So there are several things which we are launching as of now. Next week we would be covering that. So by July we would be covering a lot of videos on Murex and technologies, plus the regulation also. The price which is getting impacted here, this price has to be compensated. What they can do, they have a parent which is strong parent. Cognizant Technologies Inc. Sorry, this is a little mistake. Cognizant Technologies Inc. US. Cognizant Technologies Inc. will sign a CSA. CSA stands for Credit Support Annex, and believe me, it is not a non-cash CSA. We have few IT companies in India, those who signed the CSA, and this is non-cash. We are not here talking about the non-cash CSA. They have signed the cash CSA with all the banks. Of course, in a practical sense, they are going to sign up with whom they are dealing with more, but we are assuming that they have a multi-banking system, multiple banking arrangements, so they must have signed CSA with all of them. Now there are two kind of collaterals which this company can keep. One kind of collateral which liquid collateral, and one is non-liquid collateral. What is liquid collateral? Which is cash they are keeping with this bank in the form of a deposit or in the form of money market mutual fund, which is earmarked. Earmarked means which cannot take away. So Cognizant US will invest some cash, say with CBA, Commonwealth Bank of Australia. So the Australian entity of Cognizant, once they are going to dealt it, they are going to be covered under this CSA. And suppose for that they are maintaining some FD, right, with Commonwealth Bank of Australia. Now that FD, the collateral which they are pushing could be liquid collateral and non-liquid collateral. Non-liquid collateral would be covering bonds and all. Now the point of opinion is that, I hope you read that there are a lot of action which is happening in the market pertaining to the discounting of these collateral. There are several articles which are coming in the market, and hopefully the magazine which we are publishing for the month of April, that is coming next week, we are trying, we apologize that there is a little delay from our side. This would be covering such articles also. So, so non-collateral, the valuation of the non-liquid collateral is an issue for a bank. The reason here is, sometimes you do LIBOR discounting, sometimes you do OIS discounting, sometimes you do sterling discounting. There are even in the UK there are two indexes which are currently being considered to replace LIBOR, and I strongly doubt that this globe is in a situation to discount LIBOR. So what it happened that because of FRTB all the banks have asking their clients to sign up a CSA again, and here the banks are divided into several fraternities. So there is a bank who is saying that you discard the old CSA and sign a new CSA. There is a bank who are saying all the previous trades are covered in the old CSA, the new trades would be covered in the new CSA, and there are the banks who are creating a problem. What they are doing, they are creating a dual netting sets. What they are doing, I'm not sure that their systems are so upgraded or not, why they are asking their banks, their clients to have one CSA for all trades and one CSA for the new trades. I don't understand that. But still, what they are doing that, for a trade which was already been passed through a CSA, already being netted off, has been netted off again in the new CSA. And this problem comes again if you have a non-liquid collateral, because there are many companies in US, those who signed the Credit Support Annex CSA with their banks, whereby they have placed non-liquid securities. Example corporate bonds, example debentures, example commercial paper, example certificate of deposits, and many things. These non-corporate securities which they have, these non-liquid collateral security they have, it is very difficult to discount that. And even the TMSs like Murex, like Calypso, they are not made accordingly. They are not designed according to that. So in that regard, what exactly which is happening is that there is a dual netting problem which is coming, which is that in the earlier CSA you already netted that, it means there is a charge. Example, in a forward contract for 5 years, assuming there is a premium of 17 rupees. So first net already happened, which is 50 paisa, which is old CSA. Second net, which is again happening, which is 100 paisa, which is new CSA, which is reducing the price by 1.5 rupees for Cognizant. And this is an issue. This problem is known as dual netting sets. Although there are a lot of talks which is happening in the market, there are a lot of websites which are discussing about the dual netting sets, but I don't think that there is an immediate solution to that. In my personal opinion, once the FRTB will get active in 2019, in 2019, because MiFID is coming in 2018. Once FRTB will get active in 2019, then it would be difficult for banks to get it done. So I think there is a strong change which is required in the regulatory framework, because I don't think that even such big companies like Cognizant can afford to have a dual netting sets. I don't think so. They can even afford that. There could be many companies who are not aware about the problem of the dual netting sets, but they must be getting done. There are companies who are supporting non-liquid collateral, but they don't know at what rate it is getting discounted. Parallelly, there is a committee which is there in the London who is looking after to replace LIBOR. I doubt that they are able to replace LIBOR in a shorter span of time, but I have not been able to comment on that. So this dual netting problem has to be replaced, and if it is not being replaced, then it would create a valuation issue in P&L and also in the hedge book, and it would be difficult to do hedge accounting also. You must be surprised that in this complete setup I have not discussed IFRS 9, because if we are going to cover IFRS 9, then under hedge accounting this dual netting setup is again an issue. And if you read the complete IFRS 9, then you will get to know that IFRS 9 nowhere being synchronized with the dual netting sets. Nowhere it's being synchronized. This is an issue which needs to be addressed immediately. In my personal opinion, there should be a technological change that would happen. TMSs should upgrade themselves. TMS stands for Treasury Management System. At the same time, we should discard the old CSAs and make it a fresh one, because FRTB is coming 2019. If we not been able to discard, then we should wind it up, the new CSAs, and work on the old CSAs. And politically speaking or non-politically speaking, we should try not accepting the non-liquid collateral, because of course the valuation is an issue in that. This is the purpose of this video, which will tell you about the dual netting sets, and it will tell you that how the scene is happening and how the things are happening. You always welcome to connect with us at www.treasuryconsulting.in, and my mobile number is 9899242978. My email ID is rahul.magan@treasuryconsulting.in. Thank you very much and have a wonderful time.